Welcome back. So we got 83-point cut on the Nifty. We're at 11,229 and things are down and out. 30-odd points, actually 35 points. Additional pressure has come in since we started trading hour at 11 o'clock. That's the count as of now. And as has been pointing out, lots of stocks is where most of the action is. I mean, look at something like a DLF. It's cracking once again, almost down 6%. Down under 140 odd rupees or so. We'll highlight more. As the second quarter earnings season kickstarts today, we've compiled what some of the top brokerages are expecting top down from this particular earnings season. My colleague Nimish is standing by with the key summary and the highlights. Nimish.
Thanks, Prashant. So yes, you're right. Officially the Q2 earnings kicks off today with IndusInd reporting in the next couple of hours and TCS by end of the day. So I've just looked at most of the brokerages and what they expect from Q2. Broadly, from a top down, it looks like a subdued quarter as it was in Q1, and no fireworks is expected from any of the brokerages. To start with CLSA first, they expect the Nifty profit before tax to decline 7% and PAT to decline 4% YOY in Q2. Barring financials, across the board, the earnings are going to be weak, is what CLSA believes. And the domestic trends within the domestic companies, the trend seems to be further deceleration. So do not expect any more fireworks from the domestic companies as well. However, there are a few companies where CLSA believes the earnings will be good. And within that, the likes of ICICI Bank, Axis Bank, SBI, they're expecting a good quarter from them. Ultratech is expected to report strong numbers in Q2, and so is Asian Paints. There are a few companies where the earnings are going to be weak, according to CLSA. That includes the names like Maruti, Ashok Leyland, JSW Steel, and Tata Steel. So that's the pack from CLSA. If you look at the Morgan Stanley note, they feel that the Sensex revenue growth is expected to be slow to a 15-quarter low in Q2, and the net profit is going to be a 5-quarter low in Q2. So it's not going to be a great quarter, according to Morgan Stanley as well. However, they feel the corporate tax cut, which was announced recently, and the INDS change will be a key to monitor from a bottom line point of view. So that's something to watch out for most of the earnings in the PBT level or the PAT level. If you look at the Citi report, even they feel nothing much to cheer about is what they've written in the Q2 preview. And again, they said that the tax impact cut will be the key thing to monitor. In terms of Sensex Nifty, broadly they expect 3 to 4% decline in PAT in YOY, and even they've looked at some surprise candidates in terms of positives and negatives. According to Citi, the positive earnings for this quarter are likely to be the stocks like Dr. Reddy's, HDFC Limited, HCL Tech, and SRF. And in terms of negative reactions which are likely to come in these earnings, Tata Steel, Maruti, Concor, and Nestle. So these are the 4 stocks where they feel the earnings are going to be slightly negative. So broadly, as I said, no fireworks, expect a subdued quarter, and everyone believes that the PAT level is going to be at least 3 to 4% decline, barring financials. Across the board, it's going to be a weak quarter again in Q2.
Okay, all right, Nimish. Thanks very much for that comprehensive take in terms of what the big brokerage houses are expecting from the entire earnings season. But staying with earnings, obviously, it is kicking off today with TCS and IndusInd. TCS first. They report later this evening. Rima joins in to give us a preview. Rima.
TCS numbers will be out post market as we are expecting growth to be lower than what they had delivered last year. So in dollar revenue terms, it should be a growth of 1.8, 1.9%. In constant currency terms, we're expecting a growth of 2.5% compared to 3.7% that they delivered same time last year. The key reason being that the management commentary has turned incrementally worse on BFSI, particularly the European capital markets. Add to that, there are certain headwinds in manufacturing, particularly the European automakers, as well as the retail recovery seems to have been pushed forward. So that's the reason why growth could be lower on a year-on-year basis. Growth rates could be lower on a year-on-year basis. Margins will expand, according to our poll, by about 100 basis points to 25% on the back of absence of wage hikes as well as visa costs, and the INR depreciation will help. If you look at the profit number, it's expected to see a muted growth of 2.5%, and this is despite the margin expansion, and the key reason being the other income could be lower on account of dividends being paid out. Now the question is, does the company still end with a double-digit growth for FY20? Well, this was the expectation when in April when they came out with the Q4 numbers, but in Q1 as well, the growth rates was lower than what the street was anticipating, and Q2 could also be, Q2 estimates have also been progressively downgraded through the last few months, which is why, despite delivering double-digit growth for the last 4 quarters, this time around it could be. Another few things to track will be the demand trends in BFSI, retail, order booking, etc. But even as expectations have moderated, the stock performance too has come down. In the last 3 months, the stock is down close to about 8 to 9%. It's underperformed peers like Infosys, and its valuation premium to Infosys has also come down to just about 10% now.
Okay, Rima, thanks very much for that. Do remember to catch the management addressing the press briefing later today at 5:15 only on CNBC TV 18.
Okay, any which way, let's now focus on the markets. Let's focus on the fundamentals as well as the mutual fund data, which in fact came out last afternoon. We have Sunil Subramaniam, who is the MD and CEO of Sundaram Mutual Fund, who joins in now to discuss the fundamentals of the market and the flow picture. Sunil, hi, welcome to the show. Well, flows into equity MFs have seen a decline this time round. From that high of over 9,000 crores in August as well, and this is despite the entire, fervor with regards to the corporate tax cuts. What's your sense? What happened this time?
I think what happened, if you disaggregate the net sales number and you look at the gross sales up separate from the redemptions, I think there's been about a 5% drop in the gross inflows, but there's been a 20% spike in the redemptions. So what has led to the drop is actually redemptions. And when I say redemptions, then obviously you're talking about an existing base of investors booking profits. So I think this is more of the rally that happened post the corporate tax cut meant that a lot of people who had invested and probably seen an erosion in their market value and saw that coming back above par felt that this is a good time to get their money out. So I think, and that money would come back, in a later bit whenever there's a positive view. This is more like, I know somebody puts in that money at 10 rupees NAV, it's gone down to 850, and when it comes back to 10, he kind of says, okay, let me let me then walk out while I'm on positive. So I think it's just the profit booking which has led to the decline. The gross inflows are down only 5%, and I see that the SIP numbers have reasonably held up at about 8,260 crores. So retail investor interest isn't flagging. I think broadly the SI numbers have been stable, and so I think in the coming months you will see a reversal and the moves come back to positive territory.
This redemptions, gross inflows, as you said, are up 5, but redemptions picked up far more. I mean, this has been true for the last couple of months, not just the previous month, right? I mean, before that also this was the trend, and if this gap keeps widening, inflows become even more tepid and redemptions pick up. I mean, is there any reason to expect that will not be the case given the underlying state of the market we are still facing?
Yeah, the reason I'm saying this is that, see, the flows are a function of the overall flows into the financial services space, right? So an investor clearly is not spending today. So the consumer surplus that investors are having is not going into spending, it's going to savings. Now, where is it going in savings? I think it's going into bank deposits, because related to inflation, there's a huge real rate benefit which customers are getting today. If you say 3 to 4% inflation and 6 to 7%, so they're getting 3% effectively risk-free return on a bank deposit. Because as you know, the perception on bank deposit, especially PSU banks, is that it's government guaranteed, and which is also true from the government's past actions. So I think the main reason for this is that the money is going into the bank deposits. But over the next few months, as rate transmission happens on the lending side, you would expect the deposit rates also to get cut. So as that comes down, then the attractiveness of bank deposit vis-a-vis an expected return from equities, you'll see that balance slightly tilting, Prashant. So I expect that flows into equities, and with the tax saving season also commencing from this month onwards, I think you will see a healthy flow back into equities from now until March.
But SIPs have done well, Sunil, 8,000 crores plus in terms of flows for the 10th consecutive month. What's your sense in terms of what's going right there? And do you expect the ticket to probably go up, maybe increase beyond this 8,000 odd crores? What's happening in that space?
I think in the SIP space, I think new SIP flows have been coming in, but there have also been maturing SIPs which, some customers are not been growing. So I think that's why the net number is hanging around the 8,200 crore, 8,000 crore space. But I think that with what I just said in terms of reflow, I would expect this number to touch 9,000 before the financial year end easily. So I don't see that I see this as a very temporary trend in terms of the number remaining stagnant. I think that in the coming months, right, you would see this trending up, and I would say touching 9,000 before March as a monthly inflow number. I would expect that to happen sooner.
What is happening with regards to your funds? Sorry, I think we missed that. The last bit. Sorry, please.
Yeah, no, I said especially in the mid and small cap space.
Right.
1 year, 3 years, there were SIPs running negative, so people who maturing may not have ready. But you've seen now that the trend is changing. Now the mid and small cap, there has been some amount of revival. I think 1 year mid cap index is already showing positive returns. So I think that again will lead to a fresh pickup and flows into those segments. I was just rounding off my point there. So sorry, you were asking about.
No, I think we got that. So we'll leave it there. Thank you very much for joining us. As always, it's a pleasure, and I mean, great listening to your perspective on the monthly data, as well as what's happening with the state of the market. Well, we're down about, what, 74 odd points, 11,240 odd, so things are under pressure, but it's not turning out to be another big slide, at least not right now. Indiabulls housing has recovered. It was down 19%. It's up about 4% from the day's low. So the stock's at about, what, 201, 202 odd rupees as things stand right now.